Hi, good morning, everyone. Thanks for joining us. This morning, we've had two very interesting sessions talking about artificial intelligence and the opportunities in investing in the companies that enable or provide AI services and solutions to everyday people. At BlackRock, we fundamentally agree that that's a huge opportunity set as well. So you as an investor, you invest in a company that provides semiconductors, software, or anything that participate in the growth of AI, we too think that that's going to be an important growth sector over the long term. But let's think about it a little bit differently. Now that we have AI in our lives, and they help us do things better, faster, maybe safer, maybe even bigger. Think about it, could we possibly use AI to help us inform our investment process? Is AI something that we could potentially use in terms of making better investment decisions, hopefully generate better returns, maybe pick up a little bit of income along the way? So that's what at BlackRock, we have been doing this for over 20 years. We've been using big data, machine learning to be able to help us do investing better, and we're going to talk about one of those strategies today. But before we get into the nitty-gritty of what the strategy is about, I wanted to talk a little bit about getting back to basics. How does someone invest? If you want to invest in anything, let's say you want to buy a house, what you need to do is you do some research. You look at the price that the seller is trying to ask from you. You want to look whether there are schools nearby. You want to see whether there is good traffic or whether it's bad traffic. You want to know whether your neighbors are good. You want to know whether it's safe, maybe not so safe. So you do your own primary research. You walk around the estate. You go to Google Maps. You see where the schools, MRT stations, bus stops are. And then from that comparative, go, okay, I think a fair price for this property is this price. In fundamental investing, in the stock of fixed income investing world, we do very similar things. At the end of the day, we try to identify whether the asset that we're trying to acquire, the stock of a company, whether there are reasons for that value of that stock to go up. And the challenge with that really is that, guess what? There's this thing called information overload. Even buying a simple stock requires you to be able to take so much information into consideration. Whoops. So the challenge is that when you invest in a house, it's quite clear, all of us can understand, look for MRT, look for schools, look for a connectivity to the city, how far is it nearby or not. In stock investing, we also try to identify things like free cash flow, earnings growth, look at valuations, whether the stock is expensive or cheap or not. And the amount of information that we need to consume to be able to make that informed decision is actually very, very fast. And in fact, it's growing every single day because there's this thing called the internet. All of us are consuming, and guess what? Also contributing to the information that is required for us to make better informed decisions. So at BlackRock, how do we do this? We do this through systematic investing. We use systematic investing because the average human being has only 24 hours in a day, and we need to sleep, we need to rest, we have emotions, we get tired, our boss or our family get angry with us, and it affects our investment decisions. We want to make sure that we do it in a way that allows us to be data-driven. That means taking the emotions, taking the heart out of the picture. We want to be rational. We test it scientifically to make sure that whatever assumptions and outputs that we get from it consistently is repeatable and reliable. We also want to be disciplined in terms of how we put a portfolio together or even building the investment process. And the most important part of it is we constantly challenge ourselves. So we refine the process. If you get an outcome that we like or don't like, we continuously reevaluate whether this makes sense or not. So this entire process makes sure that our investments arrive in the portfolio in the most robust way. So how do we even start this process? Given that we want to be able to use data to be able to inform our investment decisions. So the first thing we do is we begin at the fundamentals. So I've been in the asset management industry for over 20 years. And I remember when I first began my career, the average analyst, the desk of an average stock analyst will be filled with paper. The average analyst will have to go through the balance sheet, financial statement, quarterly earnings, and also need to join regular earnings calls to listen to what the CFO or the CEO says about the company, how well they've done, what do they forecast for their future. And so the starting point is basically asking exactly the same questions that the traditional investment analyst would ask. So the first thing, is this company strong? Does it have strong fundamentals? Does it have resilient earnings? Does this company continue to pump out good products and services that the world wants? Does it have good profit margins? Is there good management? So all these very fundamental, very traditional questions that a regular fund manager or an analyst would ask are the same questions that we ask as well. And then we think about sentiment. We want to know whether the rest of the world likes this company or not. So the unfortunate thing about the world of investing is that a good company may not be a good investment. So even though a company may have very good products, very good services, continue to generate very good profits, for some reason, some people may not like the company so much, or they expect this company to not do so well, then you will see some challenging price performance on the stock price. So we also want to be able to tell whether sentiment is positive or negative for that company. And then the last part is the macro themes. Because we are not stock traders. We don't aim to trade a stock in and out to generate short-term returns. We want to be able to make sure that companies have long-term resilient growth. So we look at macro themes. These are themes that we know that are continuing to compound and grow over multiple years, maybe even multiple decades. And one of the megatrends that we focus on, we spoke about earlier on, is called artificial intelligence. So that's also one of the megatrends as well. So we know that companies that participate in strong and attractive growing macro trends, we think that the chances of this company doing well are higher rather than lower. So that's why we think that it's important to realize that what we are doing is that we are using machines to enhance the human experience. So it's not, we don't invest by creating an algorithm or a macro and then let the machine invest on its own. So as you can see earlier, the AI-generated image by that iFAST showed you, the thing about AI is not fully autonomous yet. It's not ready to be something that we allow to the AI system to drive our investments. In fact, it actually helps us enable it. So this is important because this is not autonomous driving, this is assisted driving. So we always have the hands on the wheel. There's always a human being making sure that the outputs, given the assumptions they put into the AI methodology, gives sensible results. So the human component is actually very, very important. So this is where the world of data becomes even more important and very, very big. So we start with traditional data. So things like your balance sheet, your stock data, stock price, we look at quarterly reports. We also look at alternative data. So beyond the purely financial aspects of the company, we also use data from additional sources that help us inform whether this company is good or not. So you think about any company, or whether it's a manufacturing company, or whether it's a retail F&B company, or a financial company, generally, if that company is hiring more people rather than firing people, that's generally a positive sign. So what we do is we actually use the internet. We also buy data. In fact, we're one of the world's largest buyers of data to be able to get data on whether this sector or this company is actually expanding. Are they hiring more people? Are there jobs postings that are increasing every day, every month? If that's the case, that generally suggests a positive sentiment on the company. We also look at things like maps. We also want to be able to see whether logistics companies, are they making more flights? Are there more trucks traveling more distances? Are they making more trips? Are they delivering more goods? That's generally a positive sign on the health of a logistics company as well. And the thing is that we do this in multiple language, and we use sources of data that you, as a buyer on Amazon, or you as a user of Grab taxi services, you contribute to that data set as well. So this gives you an idea of how we structure this. We use the first part, natural language processing. We use advanced machine learning tools, and then we use large language models. What this basically means is we start with a very large data set, right? So for example, broker sentiment. So we use natural language processing to be able to access that alternative data, which is infinite in nature and very, very large. So rather than hire more people to process the information, we use AI to help us process the information. We take the information, and then we use and enhance our systems to be able to do it faster. So we have first part is more, second part is faster, and the last part is ultimately our goal is to arrive at predictability. Does this data help us make predictions on whether the stock price will go up or whether it will go down? And you can see that the model accuracy has increased significantly and even better than ChatGPT in terms of predicting stock price performance. So this is where it's very important because all this is still fundamental. It's just that we use AI to do it bigger, faster, and also a lot better. Now I'm going to show a short video. I hope this will be interesting to you. Don't worry about the little words, okay? Now, just to give you a bit of a background, so when a stock analyst is analyzing a company, whether it's Amazon or Microsoft or any other company in the world, the CEO and CFO typically holds earnings calls. So it's earnings season. The senior management of the company will gather all the brokers that research that company over a call, and the senior management will then update on the health of the company. This quarter we did this, last year we did that, whether we are good or bad. And it's verbal, and usually it's also recorded where there's a transcript. So what you're seeing in front of you, don't worry about the little words, this is literally the transcript of an earnings call. And the thing about an earnings call is that words are used. And through that transcript, you can extract data. So words like happy, surprise, exceeded, these are positive words, right? And then there are also negative words, things like disappointing, surprise on the downside, right? Missed. These are negative words that they could actually tell us that maybe not so good on some aspects. So what we do is we use our system to be able to distill the earnings into positive and negative words. So the green words are positive, the red words are negative. And through the half-hour call or the 45-minute call, we then use the machine learning to be able to count the number of positive words and compare that against the number of negative words. This gives us a very baseline comparison on whether are there more negative or are there more positive words. And very simplistically, if there are more positive words than negative words, it generally suggests there's optimism by the senior management of the company, and therefore there's positive sentiment on the company as well. So this is what we call a bag of words, because it literally is all the green lines, those are positive words, and all red lines are negative words. It sounds very rudimentary, sounds very basic, but it's a starting point of where we use machine learning. And this is a simulation of analyzing a real earnings call more than 10 years ago. So this is version 1.0 of how we actually invest. So as you can imagine, in the earlier part of my presentation, I talked about how we refine our models to make sure that we continuously test our assumptions. We wanted to know, is this effective or not? So we started with traditional earnings revision. So a traditional stock analyst goes through analyzing the companies and then makes whether a positive or negative call on the stock. We were able to calculate that this is roughly the value added from traditional earnings revision. We started with our bag of words more than 10 years ago, version 1, and we refined that model over the years. And you can see that we've been able to calculate the significant value add of using our systematic investment process to help us make better informed decisions. And now we have an adaptive model that helps us take even things like sentiment on the word level. So it's not just counting words. Now we actually look at the nuance of those words, and we do it in multiple languages. So we hope that's super interesting. Putting that all together into a fund that you can invest in. This is called the Systematic Global Equity High Income Fund, which we affectionately call 𝗣𝗫, because yes, BlackRock likes long fund names. So this is the 𝗣𝗫 fund, and again, this image is also AI generated as well to describe the fund. For all that I presented today, I think there are 4 main things that I'd like you to walk away with about this fund. The first is that it's high income. This fund aims to generate about 7% per annum in terms of regular dividends. It's paid on a monthly basis, available in various currencies, including US dollar and Sing dollar hedge. And it's also lower risk. Part of the reason why it's lower risk is because it's very, very diversified. Now, if you compare to a traditional global equity mutual fund, you'll see anywhere between 30 to 100 stocks typically within a portfolio. This fund has an exposure of about 300 plus stocks. And we do this with a systematic process. We use big data, we use machine learning, and we use large language models, and of course AI to help us drive our investment process. So one interesting outcome of this unique approach also, remember, we're delivering high income, we're delivering high returns and low volatility. But one of the important outcomes of this is that because it can use alternative data, it can feed very transitory, short-term data into the portfolio to help us make informed decisions faster and quicker than a traditional managed mutual fund. And if you look at the performance of this fund during difficult times, and guess what? The problem with investing is there are things that happen in the world, macro events, that is unavoidable and will also have an impact on our portfolio. We wanted to understand whether our investment process, did it give better outcomes for our investors? So whether it is China hard landing, or whether it's the China trade war, US-China trade war tensions, or even COVID, you can see that the fund delivered lower volatility and lower drawdowns than the broad market during those challenging times. So we think ultimately that's what investors want. They want good returns, they want good income, but they also want a smoother journey. So this portfolio sits very nicely in the core part of your overall portfolio, where you can invest over the long term and enjoy the regular income coming in as well. So we do this by basically mixing three things together: high total return stocks, high yielding stocks, and stocks with characteristics of high quality. Since I have a little bit of time, I'm going to add a little bit of additional information here about why this is important to you. If you think about traditional dividend investing, and you probably do it on your own personal portfolio, many of us here own DBS stock, right? DBS shares. Why do we love DBS? Because the dividend is very stable, right? And because the dividend just keeps coming in, I'm happy to own it, and I'll be able to get a consistent income. But the challenge with a high dividend only approach is that you miss out on the growth factor. So companies like NVIDIA, companies like Apple, Microsoft. So if you only restrict your portfolio to dividends only, you'll not be able to get a meaningful growth exposure over the rest of the portfolio. So this is where the systematic investment process comes in as well. It allows us to tactically position the portfolio to clip regular coupons during the dividend cycle. So we'll be able to generate the coupon when the company announces a dividend. And once we clip that coupon, we rotate the portfolio back towards growth stocks again. So this gives you a very nice balance of being able to be exposed to the general uptrend of growth companies, but still being able to clip coupons. That's dividend harvesting. And that's something unique to this fund. Very few other fund managers do. That allows you to be able to generate income through dividend harvesting, but still be able to be exposed to growth factors across the rest of the portfolio. So what does this mean for you as an investor? It means that you get better returns than other global equity income funds. So on average, the peer group delivers about 7.3% on average over the last 5 years. We've been able to beat that by over 1%. And also the volatility is lower. So you see that the peer group has about 200 basis points more volatility than a systematic global equity high income fund. Wrapping it all up, why this is significant is because systematic investing using big data, machine learning, AI allows us to invest at scale, access data that a traditional human-driven only investment process will not be able to access. So this allows for a very effective global equity investment process. We do this with consistent income delivering 7% per annum. And on top of that, you get growth on the equity portfolio level as well. And we've been doing it for over a decade. And then we manage that risk where you get both lower volatility and lower drawdown as well. I thank you for your attention. I apologize that we're not able to go through much more detail, but if you are interested to know more, the BlackRock booth is right behind you over your left shoulder. So please pop by, get a nice little gift, talk to the guys, and I'm sure we'll be able to happy to answer your questions. Thank you very much.